Well, good morning, everyone, and welcome. It's great to have so many attending today's session. As stock pickers, market quality and value still on offer. My name's Jason Guthrie, Head of Wholesale at Natixis Investment Managers, and today we're joined by some of IML's investment team there in Sydney. Welcome, Hugh and Dan. It's good to see you both this morning.
Thanks, Jace. Good to be here.
Now, Hugh, just by way of introduction, Hugh is IML's Head of Research and Senior Portfolio Manager, responsible for a number of the large cap strategies at the firm. Dan Moore is also Portfolio Manager working alongside Hugh, and they both joined the firm back in 2010. So today, look, Dan and Hugh will discuss the key drivers of the current market, do a bit of a deep dive into the IML large cap portfolios and how they're positioned, and they'll also spend some time looking at some of the key companies and investments in the portfolios where they have particularly strong conviction today. Before we do dive in to the session, and we might get you to flick to the slide there, just wanted to quickly recognise the team there that have recently been nominated as a dual finalist in the Lonsec Money Management Fund Manager of the Year Awards. That's both the Equity Income Fund in the large cap category and also the IML Smaller Companies Fund in the small cap category. So well done to the team. We have also listened to your feedback, clients. They do tend to love podcasts, so it tends to be a great way to consume information on the go. So we have listened, and I encourage you to tune in to our latest podcast and new podcast, Navigating the Noise. It's accessible via the website, but you can also get it on the major platforms like Spotify, Amazon, and Apple. Now, I think Dan actually featured in the most recent one where he was talking through AI, artificial intelligence. Certainly a very topical and a bit of a focus area for markets at present, Dan, but it was a great discussion, and I encourage you to listen in, and I'm sure he'll touch on some of the key points today. Look, we will take some questions at the end. We'll allocate some time. Thank you to the clients that have submitted questions already, and feel free to add further questions in the webinar app over the next 15 or so minutes. So that's really it from me. Please enjoy the session, and I might hand over to Hugh and Dan to get into markets.
Thank you, Jason. So, look, it's fair to say we haven't been having the easiest time of it, but it is in an environment where market indices have been very strong. Going back to November, where there was a lot of speculation that inflation was well under control and interest rates are going to get cut quite soon. Market indices have rallied very strongly. The ASX in 6 months is up 17%, the US market up 25%. And that's been fueled by technology companies, growth companies. In Australia, the banks have been extremely strong despite producing very, very flat earnings and not having a very strong earnings outlook in any sense of the word. When there's excitement, obviously there's excitement around certain themes, and one of the big themes at the moment is artificial intelligence, and sort of anything technology has been rallying very strongly. In Australia, for example, in those 6 months, Block is up 78%, WiseTech up 68%, and it's not like these are stocks that were sort of, on their knees before they started rallying. A Goodman Group, which is really a property company building warehouses and with a emerging business in data centers, up 63%, and NextDC, a data center business, up 50% in 6 months. And in that time, a lot of strong industrial companies have been flat or close to flat, and that often happens when people get excited about something. They have to sell something else to buy that thing, and so that this has been a funding source, we believe, for the rise in technology in banks and so forth. So a lot of industrial companies, we believe, are offering great value now. We'll talk about a few later. Inflation, however, is proving persistent. The expectations of rate cuts have fallen away as inflation has actually been higher than people thought it would be. And if you look in Australia, for example, the yearly inflation rate in the March quarter was 3.6%, but the March quarter itself was 1%, which is at a higher rate than the 3.6% would imply. It's actually, and I saw an article yesterday in the paper about Jim Chalmers, Treasuries thinks that inflation is going to be in the good range by the end of the year. we are seeing signs that, if anything, it's actually going up, not down. We've seen many a cycle before, and we've seen many fads, and so we believe discipline is key.
Thanks, Hugh. So, in these sort of environments where performance is a bit tough, when we're seeing these strong fads and themes, as Hugh said, discipline is really important. And we've been through many cycles at IML, and we could have talked about the tech boom, what happened then, or the buy now, pay later boom during COVID. But the most recent one, which was literally only a year ago, believe it or not, was lithium. And we saw enormous hype in that theme. Stocks went up sixfold, or the commodity price went up sixfold in a very short space of time. There was lots of excitement, and we all know how that ended. AI, I think sort of like the internet tech boom, will change our lives. But history has shown time and time again, investing in popular fads and themes is not really a good recipe for success. And the reason it's not a good recipe for success for investing is, by its very nature, because it's popular, because the theme is popular, valuations are extremely high. Valuations are not based on cash flow or earnings. They're really based on momentum or and hype. And that, in terms of future returns, when you buy stocks with very, very high prices, that lowers your prospective return. So paying up is normally not a good thing for things that are popular. And then the second reason investing in popular fads and themes is generally fraught with danger is because it's popular, we see lots of competition, we see lots of new entrants. That capital that enters the sector tends to lead to lots of supply, which tends to lead to falling margins or falling returns in the industry. And we saw that with the internet boom. We saw a proliferation of internet companies. With buy now, pay later, we saw many new entrants. Lithium, we saw lots of lithium mines open up, and AI, there's a whole heap of AI companies starting up as well. So we really think this is a time for caution. If we think about, well, during these periods of excess, where should you be investing? And really, the lesson from all those examples, particularly the tech boom, the best opportunities in the tech boom were actually not tech stocks. They were all the boring industrial businesses that weren't tech. They were the best opportunities in that boom to find good long-term investments. And the reason why is they were out of favor. And Hugh is going to talk about 3 stocks right now. These 3 stocks are some of our 3 largest active positions. They're all, I guess, out of favor. So we suggest people focusing on sectors which are out of favor, focus on high quality businesses rather than just the theme. And we think these 3 businesses are all very high quality businesses. And we also suggest focusing on the cash flows and the growth prospects of those businesses. And so Hugh, over to you.
Yeah, I mean, if you think about it, when you have a very popular thing, expectations are so high, the likelihood of disappointment is also very high. Whereas when your expectations are moderate to low, it's easy for the company to exceed people's expectations if it is a quality company that has the ability to grow earnings. Now, the first example we have here, we have just chosen the last 2 years, April to April, and looked at what's happened to earnings, and we haven't sort of cherry-picked the time frame. We've got consistent time frames. Earnings for CSL up 37%, the share price has moved up 1%. And the outlook for CSL is very strong. They've recently reconfirmed their expectation of double-digit growth. They're not a promotional company who's going to say we're going to get double-digit EPS growth for the next several years unless they're absolutely certain they can. They have a whole lot of new products coming out, and they have a lot of margin improvement coming because they've got a new technology that will improve the yield they get on their plasma extraction. When you look at Telstra, I know a lot of people think, oh, boring old Telstra. Well, finally, and we have been beating the drum on this, the industry was irrational, was loss-making for many of the players, not generating enough cash flow. It's a capital-intensive industry. You do need cash flow. And finally, mobile prices have started to lift. And you can see, you wouldn't believe it, that the earnings, these are EPS per share, generated by Telstra in the last 2 years, up 26%. And we still see some runway for the EPS going forward, yet the share price has fallen 9%. Third example, Steadfast, the share price is up 10%, but the earnings are up 29%, and this is a tech leader in its industry, very steady earnings growth since inception. And then, so those are three stocks we own. Well, what could we have owned and done better on performance? Well, we could have owned Wesfarmers. The shares are up 35% in 2 years, better than any of the charts I've shown you, and yet the earnings are only up 9%, much worse than all the examples I've shown you. We could have owned NextDC, share price up 51% in 2 years. They've generated neither earnings nor cash flow in the last 2 years. And they're not likely to generate cash flow anytime soon because, although the DC model sounds attractive, oh, we're servicing AI, it's a very capital intensive business and has not and probably will not spin off much cash flow in the near future.
The other thing we wanted to discuss today was we've just been back from the Macquarie conference where the team across large and small, without exaggeration, seen 50 to 70 companies present. It was quite an insightful few days, and we wanted to share some of the feedback we got from the companies themselves, what they're seeing in the marketplace. And one clear theme we heard from a number of retailers was consumer spending is definitely starting to deteriorate, particularly on the discretionary side, and particularly probably in the past 6 to 8 weeks, there's been a noticeable change. And we had a meeting with the CFO of Westpac Friday last week, and he said they can see it in the credit card data, that in the past 6 to 8 weeks, there's been a noticeable reduction in spending. Yes. In discretionary items.
And CBA just came out with some similar numbers showing that actually household spending per capita is going backwards in real terms.
Yes. The other thing, again, which was pretty common, particularly for consumer-facing businesses, is pricing power is weakening. It's getting difficult to lift prices, with the consumer. And this is putting margins under pressure because cost pressures still exist. And obviously the supermarkets are facing that headwind right now with all the political pressure. But we're hearing it in sectors which we haven't normally heard about it in before, like even the QSR sectors, the fast food restaurants, which are normally very defensive, even in pretty tough times. We're hearing of consumers trading down.
Not buying the add-ons.
Yeah, which are high margin. So there's weakness there that we haven't seen, not for a very long time. So that's quite interesting. It's a bit of a new theme developing. The other interesting thing talking to businesses was power prices. We spoke to quite a few different companies, and there was general concern about not so much the short-term electricity prices, but the longer-term electricity price.
With the green energy transition, it's very expensive. And I think the voters are starting to say, well, stop rushing that because I don't want to have to pay more for my power bills each year.
The problem we face is with the movement to AI, the demand on data centers for power is rising. And so we're seeing electricity demand historically has been very, very flat over a very long period of time. We're now starting to see growth in electricity demand. It's not significant, but we're talking sort of 1 to 2% per annum sort of growth potentially, and we just don't have the baseload supply coming to deliver that demand growth. And so there's lots of companies worried about long-term electricity prices. This is a global issue. The tech companies in the US are extremely worried and they've got their own energy divisions now. All the big companies, whether it's Microsoft or Amazon, they're buying actually power generation. So I think recently Amazon bought a nuclear power station. So this is going to be a theme in the future. Wage costs is also another issue. We're talking 5% potential wage growth with the new minimum wage fair work decision coming up in the next month or so. And then finally, a call out for Victoria as noticeably weaker than the rest of the country. And we saw some companies downgrade their earnings that had exposure to Victoria. Lifestyle Communities was one of those. And we're seeing property listings increase dramatically in regional Victoria, where people had holiday houses they're now trying to sell because the taxes have gone up dramatically for investment properties.
And all companies with a large workforce in Victoria have to pay higher payroll taxes. So that's a sort of disincentive to hire more people. So turning to more specifically to the companies, as mentioned, Steadfast has been growing its earnings per share very nicely, but the share price hasn't kept up. And what Steadfast does, a lot of people, you may have heard us talk about it before, but a lot of people wouldn't even have heard of Steadfast, but it's actually since listing several years ago, it's compounded its earnings per share 13%. And that is a mix of doing some successful acquisitions as well as good organic growth. And the product they sell is insurance brokerage. They provide insurance cover without taking on the risk of actually providing the insurance to small businesses. There's a high share across Australia. The client retention is very high at 95%, which is a very good sign of the quality of the business, that you know, the customer base very happy with them. And they have spent a lot of money over the years building a fantastic software platform, and it's industry leading. And that software platform really provides them with a moat that makes it very hard for the competition to gain share over them. The founder has been there a long time and still in the business, and they do have an experienced management team. As you can see, you know, very nice growth in the various financial metrics over the last 10 years. As I mentioned, they have this technology leadership. They have a technology platform that lets them their broking members interact with the insurance companies such as IAG and Suncorp, who provide business insurance, and it simplifies the process, it improves the productivity, improves the compliance, and gives them a real head and shoulders lead over the competition to have this excellent technology leadership.
Another company we really like right now, and this is Orica, which is the leading explosives company in the world. And why we like Orica, it's sort of similar to Steadfast, it's a business that's doing well in this sort of tougher consumer environment. And it's what we also like about it, it's a business that's growing its margins as well, and we think that's going to continue in the future. And there's not too many businesses that can grow their margins in the current environment. So why is Orica growing their margins? Well, they've invested heavily in R&D to develop new products for several years, out-investing their competitors by several fold, and that's really starting to bear fruit now. They're winning market share, they're growing their volumes, they're getting some really good price uplifts on their products as well for explosives. They've got a very large contract with BHP, they're renegotiating right now. And we suspect that's going to lead to significant earnings growth next year because it's pretty much a old historical loss-making contract. In fact, we've got earnings growth of 25% next year. And all that investment in those technology products are starting to bear fruit, as I mentioned. These are some of them right here. The key one, which is really transforming the mining industry, or will certainly over the medium term, is wireless blasting. You can see there on the bottom right corner, wireless initiating systems, the growth's been over 60% over the past couple of years, and you can see the dramatic difference it makes to the mining process on those photos. They've actually developed these products several years ago, but with COVID meant customers couldn't do trials of these products, and these trials can take up to a year to complete before mining customers get convinced of the value of these products. Those trials are now being done, all the regulatory hurdles have passed, and we're seeing increasing adoption of these products. And over the next 3 to 5 years, we're really excited about the growth and the technology of the business. These products all help miners with productivity, and miners are very focused on productivity right now because getting new mines approved is so difficult. So improving productivity is really adding significant value to miners. The third company is a position we've just entered. It's quite a small position right now, but it's a position we want to be bigger. And I'll talk a bit about that a little bit later, but the business is Sigma, and Sigma itself is a pharmaceutical distribution business. But the reason we've invested in Sigma is for their merger with Chemist Warehouse. And if the merger proceeds, the Chemist Warehouse business will essentially be 90% of the value of this merged business. So we're investing really in Chemist Warehouse. Chemist Warehouse is the clear #1 player in pharmacy retail space across Australia and New Zealand. It's a real juggernaut, category killer. It's a unique discount model where the operators, the founders, the management are first-class retailers, and really they're competing with traditional pharmacies. Over half of the competitor base is your local pharmacist, who's not always the best retailer. They're more of a pharmacist, and that's who they're competing with. Chemist Warehouse has much higher scale, much better buying power, and their sales per store are 3x those of their competitors. And you can see on the bottom right-hand corner their prices for their goods relative to other leading retailers in their category. So obviously with a weak consumer environment, consumers trading down, looking for value, we think this business is very well placed. Looking at the history of the company, it's incredibly impressive. They've grown sales at an enormous rate over 20 years, driven by not just store rollout, but they've continued to grow sales per store as well, winning substantial market share in Australia. Today, they have 27% market share, so quite a healthy level of market share, but we still see plenty of runway for them to improve their market share over time. To give you some sense of the success of the model, 80 or 70% of their sales is from the front of store, and 30% is the medicines behind the counter. Other pharmacies, it's the exact opposite. So they're out trading the traditional pharmacy really at the front of store, where they're doing a fantastic job.
And they're actually also winning share from Coles and Woolworths,
yes,
who used to make a lot of money and still make a lot of money, but they're struggling a bit with things like health and beauty, because Chemist Warehouse has good buying power and is offering those products that you can buy in Coles and Woolworths cheaper than Coles and Woolworths, or at least at the same price, and is stealing some share.
Yeah, no, they're doing a great job. And I guess what's really exciting about the Chemist Warehouse business, looking long term, is they're now rolling out stores globally, and the success is as exciting. So they've entered the New Zealand market 7 years ago, not long at all. Within 7 years, they've got 16% market share, which is quite incredible. The sales per store in New Zealand are 20 million compared to Australia at 12, so almost double the sales per store. So New Zealand's been an even bigger success in some ways than Australia. They've also entered Ireland, where it also looks equally prospective. And they're very careful which countries they go into. They're really going into countries where they're competing against pharmacy, individual pharmacists, where they can outcompete them. They're not looking to grow in markets where they have very large players who have a lot of scale. They want to go into markets where the competitive situation is much better. And on a valuation business, when you factor in the synergies, that the business looks like it's trading on roughly 25 times earnings, which we think is very attractive given the growth of the business compared to, say, Wesfarmers, which is on a similar multiple.
More expensive.
Yeah, probably a little bit more expensive, and the growth is much more mature and significantly lower. So why don't we have a very large position? Because it's obviously a fantastic business. there is merger risk. The ACCC does need to approve this transaction. We do ultimately think it will go through, but there is risk. There's going to be a statement of issues issued in June, and look, we'll judge the statement of issues and decide whether we increase the position further. But ultimately, it looks like it should get approved by the end of the calendar year. But we'll see how we go between now and then, and hopefully we can increase the position sizing.
And with that, that's the formal presentation. We're very happy to take questions, and we know some have been sent through already.
Fantastic. Thank you, Hugh. Thanks, Dan. Incredible business at Chemist Warehouse. I think I've got to go down there and top up on some beauty products actually later today. So good to hear you've found some opportunities there. Look, we've got 4 or 5 minutes left. There are some questions that have come through. So probably the big ticket item we haven't covered up on too much today is just around, I guess everyone's talking about interest rates and inflation. You mentioned briefly at the start, we don't expect things to be coming off, any deflation in the near term. Can you maybe provide some deeper views on IML's views on rates and inflation?
Look, I think that people are over optimistic about how quickly inflation will go away. If you think of the cause of inflation, there were some supply chain issues with COVID, but basically in COVID, governments spent an enormous amount of money subsidizing parts of the economy, and a lot of that money ended up in the hands of households who went on a spending spree, and that money that got into the system pushed prices up. And as prices went up, people said, gee, I've got to keep pace with these prices. Not everyone got the money, I'm feeling poorer. So you've had wage demands go up. And so you've got this combination of some goods prices going up, commodity driven, transport cost driven, but services prices now are really quite strong, because of wage pressure. The reason inflation's come off its highs is because goods prices have come down, because you had these commodities very high, they've come off. But the services prices are still strong, and you're starting to see some of those goods prices stop going down or go up a bit. And it's actually very hard to hit rates on the head. I wouldn't be surprised if we don't cut rates this year at all. And you cannot rule out a rate increase in Australia, particularly because we're well behind all other countries. In our rate level is only 4.35. I was saying most other countries it's over 5.
Okay. All right, Dan, on the recent podcast talking through AI, you've obviously mentioned a number of companies that are implementing technology through their business. Can you maybe talk to some of the names you're looking at that are using AI, and I guess businesses that are trading on reasonable valuations that the team would actually look at putting in portfolios?
Yeah, thanks, Jace. It's really just the companies that are using AI the best tend to be the companies with the biggest scale. They tend to have the most data, and they've got the capacity to invest. So they're definitely ahead of the game out investing, I guess, the smaller players as a general comment. The businesses that we talk to that seem to have a bit of a leg up on their competitors are companies like Orica and companies like Sonic, who are both industry leaders. Use a lot of data within their business. In regards to Orica, they use a lot of data to help them improve their blasting designs, and they've got data from doing blasts all around the world, almost every day. And they're now collecting that data and using AI to help them design better blasts, the next day or the next week. So they're continuously trying to improve their business over time with AI. And the other probably bigger one is Sonic Healthcare, and we talk about that on the podcast. They have AI software products today they are monetizing already. One of the few companies that actually making money from AI, and they have software at the moment. It's in X-rays for chest. If you have a chest X-ray in Australia, there's a good chance it will be done with Sonic's AI, and that X-ray will go through the software, and it will be able to identify whether you have cancer or not. which is quite incredible. And that software is already more accurate than the naked eye of
a radiologist.
Yes, and they're developing obviously many more products. There's a brain scan product coming. They're also working on products in pathology, in histopathology as well, to improve the efficiency of their business, and they'll look to sell these software products globally.
And that's been trading sideways to down. The team's been buying more recently in Sonic, haven't it?
Yeah. Yes, so the earnings of Sonic have been falling post the COVID boom, and the share price is down significantly from their peaks. We've used that as a really good opportunity to buy it. Interestingly, the share price is well below where it was pre-COVID, yet the earnings are quite a lot above their pre-COVID levels, and their balance sheet's much stronger as well because they made an extra $2 billion on top of their normal earnings during COVID. Looks a great opportunity to us.
Okay. All right, we're coming up on time, but maybe Hugh, before we wrap up, just on financials, we've had a few come through just around the specifics on some of the banks, particularly CBA. It's been very strong lately. What's the team's view at the moment in financials?
Yeah. Well, we have been underweight the banks, which has hurt us recently because the banks have been very strong. But, if I tell you that NAB's earnings per share are now the same as they were pre the global financial crisis in 2006, you can understand that it's not rare. They're not growth companies. They do not deserve high multiples, and they do have the chance of a major thing going wrong because they lend a vast quantity of lending relative to the capital or the sort of the sort of source that they can tap into if there is a problem with bad debts. Now, we haven't had bad debts for a long time. That's been supporting their earnings, but as I said earlier, when you have a theme that's very popular, room for disappointment is very high, room for beating expectations is low. And because bad debts are low and provisions are very low, the chance for bad debts to rise as households come under a bit of pressure with the inflation in the economy, prices going up, not everyone's getting wage increases to keep up, people are being cut back, the likelihood is that bad debts rise. That will put some pressure on earnings, and they're not really growing. So CBA is apparently the most expensive retail bank in the world. NAB is not that far behind. Westpac and ANZ are a bit cheaper, but they're following their own path of trying to sort out their act. Westpac has terrible technology, for example, so their costs are going to rise, and it's very hard to see anything appealing about them. Although short term, the market is excited because they're paying a decent dividend. Not that you can't get decent dividends elsewhere, and they've announced buybacks. But our bank's analyst, who's very experienced, believes that they may have to cut dividends in the future by doing these buybacks. They may put pressure on their capital, and they have to shore up their capital by cutting dividends in the future.
Well, thank you, Hugh. Thank you, Dan. And thank you to all of our clients attending today. We hope you got some value from the session. And please do reach out to someone in my team if you'd like to discuss any of the IML strategies in detail. We're going to do a similar session on Thursday on small caps. So we look forward to seeing you then, and enjoy the rest of your afternoon. Thanks, guys.
Thanks, guys. Thank you.